In this week's update, more green shoots, but no cigar yet. The fundamentals for economies looks awful. And the perfect environment for gold, but will it perform? My name's Garry Davis. As always, this is general advice in this video, and please remember to like and subscribe. Look, let me just start by asking you to excuse my voice. In the video today, I've got a little belt of COVID for the first time, and it's just demolished me over the last couple of days. But look, this is just such an important time that I didn't want to opt out of the video this weekend, because I know a lot of people are very anxious about what's going on. So I'll battle through, and please bear with me. All right, let's start with a market perspective. The fundamental outlook, if that's all you look at, really is quite poor at the moment. There's a lot of bad news out there, and a lot of it's justified, but bad news is not the only story, and that's what I want to bring to you today. The most problematic inflation driver is coming from an unusual source, and that is supply shortages. That's not normally what drives inflation, or hardly ever. What we're dealing with at the moment, which is a result of COVID over the last couple of years, which is a result of the Russia-Ukraine war, which is a result of a whole lot of geopolitical issues, is not normal to be the main driver of inflation. The normal concern for inflation is coming from wages inflation. That's the normal source. And I think that is still going to be inevitable, because with inflation doing what it's doing, there's going to be a huge push for higher wages. So I think it's reasonable to assume that wages inflation is going to be a consequence of this. But the interesting thing about this in central bank policy is, and they've only really got one tool, they've only got one hammer, and raising rates certainly impacts the second one, but it doesn't really impact the first one at all. Raising rates doesn't help overcome the supply shortages. So the central banks are between a rock and a hard place, that they really don't have the policy tools to deal with the sort of inflation that we've got at the moment. So it's not difficult, if you want to be pessimistic, it's not difficult to make a case for stagflation for several years to come. But if you do that, if you fall into that hole, then it ignores the fact that we're very ingenious, and just look at how we dealt with COVID, which came out of the blue. It ignores the fact that innovation can move us a long way from where we are at the moment. So I wouldn't get too despondent or too resigned to where we sit at the moment. Now, I know a lot of people are getting anxious about, is the massive levels of debt that have built up over the last couple of decades, is that now coming home to bite us? But just remember that innovation can achieve a great many things. And I think at the end of the day, markets will inform us as to what's going to happen in the markets. It's dead easy for all the bearish commentators out there, and there are a lot of them, to craft a very bleak disaster outlook. It's really easy to do that. We can all sit down and write a list of 10 or 15 things that are really awful, and there's not too many things on the positive side of the ledger. But I'd really caution you against getting drawn into that without looking at what the charts are saying, because at the end of the day, it's money flows that's all that matters. We make money not because of a logical argument, but because prices move in our favour. And I really would like everyone to just think about that statement for a minute, because it's reality. It doesn't matter what you think, and it doesn't matter what's logical. We make money because we buy low and we sell high. That's it. So that's what you need to focus on. How do we do that on a consistent basis is the only question. And you can just leave all the rest of the stuff, which is unknowable, we can't control it, So just leave all that to the side and just focus on, buying low, selling high, and doing things that have got high probability. And that's it. Beg your pardon. Okay, now we've got a number of reversal boxes ticked, and I've been covering this now for the last couple of weeks. And nothing really happened in the last week that changed that. But we still haven't moved to a point where, I can feel confident that a major low is now in place. But we've certainly taken a few more little steps along that path. So the spread charts are, continuing to show rotation. It's just the rotation is not what you normally see. It's not robust. It's not sudden. It's almost imperceptible, if you like. Sorry, my brain is not functioning all that clearly this morning, but certainly I've given this video, the content of this video, a great deal of thought over the last 24 hours. So, that side of things I'm very clear on. Now, so the spread charts are showing a rotation. So there's a box ticked. The level of fear has gone to yet another level. The sentiment has got a little bit worse during the week. The put to call ratio has got a little bit higher, and it is now certainly at a level that is consistent with major lows. But that in itself is not enough. But it's a heck of a good start. We're certainly down to an area where a reversal would be normal and would make sense. We've also seen a reversal in the junk bond area, as I pointed out last week, and there was nothing that happened during the week, despite the fact that equity markets continued to fall significantly. Junk bonds were able to pretty much hold the rebound that they showed last week. The news flow itself is just simply awful. I mean, there's just nothing positive out there at all. So, you would be easily forgiven to think that, that we've still got a ways to go in this bear market. So that's the situation. We've got boxes being ticked, but there's some boxes that are yet to be ticked. And the main one, and this is the one that, is the ultimate for me, is that we haven't seen any emphatic reversals either at a sector level or at a stock level. And I'm focusing mainly on America because that sets the tone both on an overall market and individual sector level for the rest of the world. I could look at Australian indices, but they're just going to really follow what's happening in America anyway. So a possible way forward, there's a couple of possible ways forward here, given that we're in a position where we should be seeing quite an emphatic reversal. And Friday night being options expiry was a good opportunity for that, and it didn't happen. So it leads me to conclude that we're probably going to get something that's a little bit different and unusual this time in terms of the rebound. And a possible way forward is that we do get, this gradual rotation where smart money is starting to move back into the growth areas because it perceives that there's real value there, but there just isn't much momentum around it. And so what we could end up with is some sort of W-shaped bottom form that might take several weeks or several months to actually come together. There's another possibility that I'll be certainly sharing with members during the week. So what we're needing here is some sort of trigger to get the ball rolling again. And I don't know what that that trigger can be. Any one of a number of things. It could be an inflation number that moderates a bit, and then that changes the whole Fed rhetoric and the outlook. It could be some development in the Russia-Ukraine war. There's certainly enough things out there that could trigger a reversal. I think the important thing to recognise is that we're certainly at a level on a number of the fear gauges that it would make sense for the market to reverse. Whereas for those of you that watch this video every week, you may recall that back in March when we got quite an emphatic reversal, that I said it just we hadn't ticked enough boxes. It hadn't gone long enough. We hadn't gone deep enough. The put to call ratio was still too bullish. It just didn't fit. Whereas now, if we get a reversal, then it certainly fits because so many of the other boxes are ticked. Okay, let's look at some charts to start with because that's the key. So we'll start with the Nasdaq against the S&P. Oh, I'm very sorry about my voice. This is the Nasdaq versus the S&P. So you can see we're still in a consolidation here, but we've not fallen apart again, and we've got the start of a higher low. So it's at least a step in the right direction, but it's not definitive, as with several of these things. This is consumer discretionary versus consumer staples. Just an awful environment for consumer discretionary. And yet it was, we actually ticked up in the last, on Friday, we actually ticked up. Now that could be options expiry related, which is, just a bit of an abnormal session because of the way prices get manipulated around options expiry. But at the moment, we've still got a higher high and the possibility of a higher low. But overall, we're still in a downtrending channel, so we can't get too excited yet. Russell 1000 growth. Now, this is looking a little better. So, I take a little bit of encouragement out of this, and we did tick up over the last 2 of the last 3 days in America. So that one's looking a little better. Small cap growth versus small cap value. Now, definitely some better signs there as well. So there's certainly some green shoots, no question about it. But the thing that's holding me back, so let's go and look at some of the majors. So this is Amazon. Now we're at a double bottom, but for this to be a reversal that you can have confidence in, this should be a much more definitive candle. It should be longer range, close up on its highs. We probably should have bigger volume. Should be something more like this. Or perhaps like bigger volumes like this. We're just not seeing that emphatic move that we've seen here and here. Now that's yet. It still might be coming, and it could come any day. But at this point in time, it's a bit wishy-washy. Look at Apple. Same situation. We've now broken support on Apple. The opportunity for a reversal, nice volume, but closed well off the highs. That means the sellers came in towards the end. It's just not emphatic enough reversal to suggest that we're going to get a more significant rotation into these sort of stocks. Microsoft, again, a bit wishy-washy. Higher volume, but closed well off its highs. It's just not robust enough to give me the confidence for what I'm looking for. Semiconductors, a really important sector that's had its challenges with supply chain issues, but that's pretty indeterminate. Let's look at some of the sectors. Now, energy, overall huge uptrend, been the strongest sector all year, and I guess it was right for a sell-off. And lo and behold, we get a sell-off into options expiry because there would have been a massive amount of in the money call options. So for those that can and do manipulate the market, this was an ideal time to engineer a huge burst of profit taking. At this point in time, I reckon that's probably all it is, just a burst of profit taking, and could well be an opportunity. This is XLK, which is the overall technology sector, so that really just reflects what we've just seen in the Amazons and the Apples and the Microsofts. HYG, so we had a really strong move on Tuesday. We had a bit of a dip on Thursday. Sorry, that was Wednesday. Where are we? Yeah, Wednesday, the big move. Bit of a dip on Thursday, and didn't finish too badly on Friday, considering. So that's, that's a bit more positive than what you would expect if you looked at the equity market first. Okay, let's move on to the S&P. So the overall scoreboard for the week, the index was down 5.8, but a lot of stocks were down a lot worse than that. It's now 24% off the January top. Not that it really matters, but that means that we're now officially in bear market territory. But I think everybody knows that and understands that. Didn't need the index to fall to that level to tell us that. Friday options expiry does muddy the waters, because there's no question the last couple of days are normally suffer price manipulation. So it's harder to trust, and I remember saying the same thing in March of this year. It's harder to trust what is happening in the market in the few days leading into options expiry, which is the third Friday of the month, and the few days coming out of options expiry. So I remain open-minded. I'm not prepared to move on anything because I don't have confirmation yet, but I would be prepared to move at any day given sufficient confirmation. So that's pretty much it. There's certainly some green shoots. We've taken another little step along the path, but we don't have confirmation. So sitting on your hands at the moment and just observing is the preferred way to go, in my opinion. The US dollar index dipped last week, but managed to spike up a little bit to 104.5. The 10-year yield was up to 3.23 on the week, but it had spiked to 3.48, and then came off that on an intraday basis. The VIX just remains elevated. It's been above 20 all year, and it's been above 30 for a fair amount of time, which is quite unusual. The 10-year, 2-year bond spread is still positive, but only just by the skin of its teeth. So let's take a look at the 10-year Treasury. So that's just a 1 day. Let's take a look at the 10-year Treasury for this year, so over the last 6 months. And you can see it's made quite a concerted move. It was 1.46 back at the end of December. We're now at 3.23, so it's more than doubled. We're still forming higher highs and higher lows, but it's not sort of off the charts. If we look at the VIX on a year-to-date basis, it's unusual in a secular bull market to spend the entire time above 20, but in fact, that is what's happened. So there's certainly a level of fear and apprehension that we haven't seen for many, many years, and with good reason. But it's even more unusual to spend as much time as we are above 30. So, these are sort of rare times. But look, the good news here is that extreme levels of fear and reaching for put options as hedging is not sustainable. Markets, do not stay at those sort of levels. They reach an extreme, people panic, they sell off, and then life goes back to somewhat more normality. So, the good news is, as long as we, stay up here for as long as we are, we're getting closer and closer to, to a significant low. Let me go back to the charts. We'll go look at the S&P. So there's the S&P 500. So we lost nearly 6% on the week. We finished at 36.74. If you wind back to February, March, I was saying that I expected perhaps a level around 3,800. So if we put a Fibonacci retracement on this, it'll give us a bit of a framework. So around 3,800 was a level that I was looking at. We bounced off that almost exactly. on the 20th of May, which made that that May reversal more believable. We rallied strongly, but now we've come off again, and now we're targeting at the 50% level, which is at 3,500. So that would be my next target. So we've got about 170 points to go to reach that target. Now, markets don't have to move to these levels. There's not some rule that says they have to do that. But certainly that level would make a bit more sense. So that's the S&P. If we look at the Nasdaq, there's a decent level around 11,000, and we're getting very close to that as well. So I'll just put that support level on there. So bang on 11,000. We've pretty much touched that. We got to a low of 11,037 on Thursday, but there's nothing really that positive yet. So I wouldn't rule out a break of that support. But if the Nasdaq can hold that 11,000 support, and the S&P can, maybe go down a little bit further, so that what we're seeing then is divergence. If the S&P keeps falling and the Nasdaq can hold support, then that's actually a very positive sign, because it's indicating that money is preferentially going back into growth. And that's what we need to get back into a bull market. And without growth, without money flows going into growth, then we're stuck in this bear market. So that's just the long and the short of it. Okay, let's look at the currencies. So the US dollar is still forming higher highs and higher lows, but the last high was not all that much greater. It was only about 1 cent higher. We did have a very sharp sell-off on Thursday, but it gathered its feet and went back up again on Friday. So at the moment, all you can say with the US dollar is that it's trending higher. I've seen quite a bit of commentary that 105, 105 and a half should be a ceiling for the US dollar. I don't know what that's based on. Certainly a lot of people seem to be saying it, but at the moment all I can say is that the US dollar is in uptrend, and that's all there is to it. If we look at the Australian dollar, so we're just pretty much mirroring what's happening in the inverse direction, and the Australian dollar finished 68.66. So the Aussie market, we lost 6.6% across the week, so we did a little bit worse at the index level. The banks lost 6.9%, and they've really been chopped up fairly badly. And the concerns there is that their lending volumes are going to go down significantly compared to what they've been doing over the last couple of years. The level of bad debt, or at the very least, the provision for a level of bad debt is going to have to rise. That impacts their bottom line, that impacts their ability to pay dividends at the same level, and so that's why the banks are being sold. The materials sector got hit hard, down nearly 8%, and of course energy was sold off as well, and I guess we'll see some more selling on Monday. Now, for those of you that are in small caps, they continue to be smashed, but what we've got here is a real disconnection from fundamentals. So, these mining projects in battery materials, which have got just a fabulous future, they're now down at levels which are just plain silly, and so I'm not terribly worried about a continued fall in that area, because I'm totally confident that prices are going to rebound, and I'm actually seeing this. The lower they go, the greater the buying opportunity for me, and the greater the rebound. So I think you just need to look at this part of the Australian market and just switch off for a bit, because there's just no connection between merit and pricing. So, don't fall into the trap of thinking that things have changed. Now, if you're an early stage developer or an early stage explorer, then things may have changed because the cost of capital is now going to be higher. It's going to be more difficult for some miners to get access to capital to fund their development. But if you've got a decent sized project that's already well developed, the demand for all the battery materials is going to be such that I think the fundraising is going to happen. It has to happen, otherwise decarbonisation doesn't happen. But if you're a very early stage player, then it might be a bit more problematic. So we'll take a look at the ASX 200, and you can see very, very sharp selling there. And if we look at the actual indices themselves, there's materials. It's still only just a tick below the 200-day moving average, so that's not looking too bad. Sort of pales into insignificance though compared to energy, but expect energy. I do expect a fairly decent red candle on Monday. Finance, the banks really hit hard, and now the 200-day moving average is rolling over. That now completes the set for the moving averages, and I'm not sure where the bottom is going to be. We've got some likely support sort of kicking in pretty close to where we are now, so we may not be that far away that we get some sort of relief rally in banks, but whether it's sustainable or not remains to be seen. Turning now to the precious metals, with the rise in the US dollar, gold was down by $33 back to $18.39, and the Australian dollar price remained at 26.80, given the fall in our currency. Precious metals have rolled over on a relative basis relative to the gold price again, which is really disappointing and just unable to sustain momentum. And I'm just scratching my head. This is the perfect environment for gold. It just doesn't really get any better than this. We've got fear over all sorts of things, not just financial things, over geopolitical things. We've got the possibility of stagflation. It really doesn't get any better than this, and I would have thought that that gold would be seeing more support than it is. And the argument in 2021 was that, well, maybe Bitcoin and cryptocurrencies are stealing the hedging money, the investment money. But with cryptocurrencies now completely falling apart, that explodes that myth. So I have no explanation as to why the gold price is not doing better than it is. So let's take a quick look at those charts. By the way, there's Bitcoin. So we finished at 20,400. It was only back here in November that we were trading at 68,000. So certainly Bitcoin doing well in a financial crisis. That that thought is out the door. There's the daily chart of the gold price, and we're really just up and down, really just sideways across a flat 200-day moving average, which really reflects where we're at. And that's the weekly chart for gold. Silver doing worse than gold in 200-day moving average, now pointing down, and the price is spending most of its time below that falling 200-day moving average. So silver isn't getting any love either. If we look at the stocks, GDXJ also remains in downtrend. And if we look at some of the spreads around gold, just find the one I'm after. There we go. There's GDX against GLD, which is the ETF covering gold. So we're still, clearly in downtrend there. As you can see, we're in a broad channel, but that channel is still trending to the downside. So until we see gold stocks start to lead the underlying metal, then I don't think anything much is going to change. That's what we need to see. we need to see a break above this particular channel to get back on a better footing. Turning to other commodities now, copper was a bit lower, really just currency effect in my view, and just a little bit of a malaise over what a global recession might mean for metals. And nickel was at 1154, and mostly currency impact. Look, just a little bit of sentiment involved in that, but the outlook for for these metals, industrial and battery metals, really is very, very encouraging. And copper in particular, nickel and lithium and platinum group metals have been getting all the attention. But copper is perhaps the forgotten metal here. And the supply-demand situation for copper looks really awesome for the next 10 years when you look at the deterioration in the grades, and that'll ultimately play out in a deterioration in production rates in some of the world's biggest copper mines. And there's been such an underinvestment for a decade that there's just no big elephants that are on the radar that are coming through. It's going to be extremely difficult to get a supply side response in copper that matches the increase in demand that's unquestionably coming. So the 5 to 10 year outlook for copper is very, very good. Crude oil up to that should be, crude oil was down, beg your pardon, to 110. And that dragged the energy sector down quite sharply, which we saw. There's the spot copper chart. So we're down towards the lows that we've been trading at since the middle of last year, but this is still a very robust price. And any decent copper producer has all-in sustaining costs somewhere around about the $2 a pound. So this is still very profitable territory, even though we've come off from $4.80. Nickel is similar. This is still a very profitable area for nickel to be, and but perhaps the price, the incentive price, to go out and really explore to develop the extra production, the price probably needs to be a bit higher yet. So wrapping it up, my final thoughts are these: despite the price crashes, and that's in the Australian battery materials market in small caps, that's in effect what we've had. Battery materials still have a fabulous future, and you just need to, as I said before, distinguish between the merits of the projects and the price, because there is a complete disconnection. The broad demand trends are up. Supply across just about everything is really going to struggle to catch up, despite the reports that we get from the likes of Goldman Sachs that either don't look at the data sufficiently in depth to understand the industry, or for some other reason. But their report around lithium has pretty much been debunked by a lot of experts in the industry. Stock volatility cycles are very high. Stocks are always in this area are always going to be quite volatile and move through various cycles. And stocks are forming higher highs and higher lows. Despite all the volatility that we're seeing, most of the stocks are still in an uptrend. It's a wild ride, but it's still an overall uptrend. So that's the thing to focus on. So you've got to be patient and just stay focused on a plan for yourself. If you're not clear about what you're doing in this sort of market, I think you're going to be in a lot of trouble, because there'll be a point where you'll make some erratic decision based on emotion. So you just need to be very clear about what stocks you want to own, what your entry price looks like, being conservative in this market. You just can't get through this level of volatility without that plan and without the commitment to see it through. And I know I go on about this every week, but it's just, so critical. And I just get questions from people that are telling me that they don't have that clarity. And they're confused and they don't know what to do. As difficult as this market environment is, it's becoming more and more clear to me what we need to do well. I guess I can't go anywhere, so I've got plenty of time to think and analyse on the market, and I really, do feel quite comfortable with the strategy and the game plan that I've got in place for myself personally, and that I'm also passing on to members, and there'll be plenty more of that this week. So portfolio analysts last week, we did many things, but part of it was portfolio positioning. And also I touched on some stocks that really look ready to go when the market bottoms. They're not buys now. I don't think anything much is a buy now when markets are this volatile, until we see that confirmation of a reversal. But certainly there are a lot of stocks now that are in a tremendous long-term buy zone. Now, they could get cheaper yet, but they're certainly at a price now already where I think it's probably unlikely that you lose money over the longer term. I think there's a very high probability that those prices move higher once this market eventually turns. So that's it for this week. It's been a bit of a struggle. Sorry about the voice and the lack of coherency, but hopefully I'll be out the other side of this by next Sunday, and we'll see what's happened in the market then. That's all for this week. Cheers.